Well, as we've been telling you, the unemployment rate in January ticked up to 3.7%. That's higher than the market forecast of 3.5%. But the Bureau of Statistics cautions that more people than usual started new jobs or even returned to work later in January. In other words, the long January break was alive and well this year. Well, the Treasurer, he said this today.
Despite all of the difficulties being thrown at us from around the world, and despite these rate rises, we've still got unemployment with a 3 in front of it.
And also a day after ordering an ACCC inquiry investigating the interest rates that banks are paying on savings accounts, he also had a message for banks. It comes as the Commonwealth Bank announced yesterday a $5.15 billion half-year profit. NAB today unveiled a $2.1 billion quarterly profit.
We'll pass on the interest rate rises to savers as quickly as you pass on the interest rate rises to mortgage holders. And I understand that people are furious when mortgage rates go up more or less immediately and savings rates go up much slower.
Well, let's bring in here Su-Lin Ong, who's the Chief Economist of the RBC Capital. Su-Lin, many thanks for your time. Just tell me about the changing outlook with those numbers. Do you see anything big there? It's obviously higher than the forecast and the way even the Reserve Bank might react to them. After all, it has the unemployment rate forecast at 3.8% at the end of this calendar year.
So there is a lot of volatility in these numbers, and we think that while all the headline employment numbers today, whether it was the drop in employment, the lift in the unemployment rate to 3.7, the drop in participation in hours, that got a lot of attention, but it's important to look at the detail, and we don't think the labour market is anywhere near as weak as some of those headline numbers would suggest. So there's a few things to point out. We think there's a bit of payback that was going on in January. We saw some very strong employment numbers, nearly 100,000 over October and November. So maybe there's a bit of payback going on. When you smooth it out, it's still a pretty decent pace of monthly employment generation. As you pointed out, there were also a lot more people on leave, taking holidays over the course of January, and that saw a big drop in hours worked. And I think more importantly, some of these people that were counted as unemployed and helped push up the unemployment rate are not really unemployed. They're in between jobs and they have jobs lined up. So look, I think it's fair to characterise the labour market as probably past its best. I don't think we'll see the rate of employment generation that we saw in the first half of last year, or an unemployment rate back down at 3.5 or lower. But you're still talking about a healthy labour market with a bit of noise in the monthly numbers and some specific factors in January that I think made the result look worse than it actually is. The labour market still remains, in our view, in pretty good shape and still fairly tight.
So, Su-Lin, that says to me it doesn't take any pressure off the Reserve Bank in its fight against inflation, because while people have got jobs, and that's a good thing, let's be honest, they still have an ability to pay and afford higher prices being pushed up by inflation.
Absolutely. And the key here, I think, to the economy over the next 12, 18 months as the rate hikes begin to bite more and translate through to lower disposable income is the state of the labour market. As long as you have a job, your wages are rising and you can service your mortgage payments, that really is quite important in how the trajectory of the economy unfolds. And so from our perspective, we don't really think it changes the outlook for the RBA at this juncture. Inflation is too high. It is uncomfortably high, and persistent and prolonged inflation will do much more to the damage to the economy and to households over the longer term. So it's important to get those inflation rates down now from the kind of 7-8% that we see down back towards the Reserve Bank's target range and have that low, stable inflation environment. And really, like I said, there's a bit of noise in this monthly labour force number. If you take a step back, we're still looking at a very tight labour market that's beyond full employment. And I think it's important to remember that the whole idea of rate hikes is to weaken the economy. It's to loosen up the labour market. So we want to see a moderation in the labour market, and we think we'll get that, but probably not until more so in the second half of this year. So labour market's still pretty strong. I think it means very much a Reserve Bank that will continue to lift rates in the coming months to try and get on top of inflation, which looks to have surprised them to the upside, while demand has generally remained probably more resilient than they thought.
And so, Su-Lin, just briefly, how many rate rises have you got penciled in at this stage for the Reserve Bank before it finishes in this cycle?
So we were already anticipating a couple more hikes. We thought they would move in February. We also thought they would move in March, and we stick to that. We've added one more hike to our profile in April. We had the cash rate at 3.85% as the peak. But look, as we've said for some time, the risk remains to the upside. And it's really, I think the onus is on the data to weaken. The onus is on particularly some of the consumer spending numbers to moderate more significantly, for a further little bit more loosening in the labour market, and importantly for these inflation numbers to start to trend lower and head in the right direction towards the RBA's target. And so the onus very much on the numbers to weaken and stop the bank from hiking. So we have 2 more hikes in our profile. The risk is a little bit higher. We wouldn't quibble with market pricing. So markets have moved to price in a cash rate that peaks a little above 4%.
Yes.
That's entirely possible.
It's interesting to watch it. Su-Lin Ong, thank you so much for that. It's going to be interesting to watch a chief economist at RBC Capital.